Credit risk exposure is simply the risk that someone who owes you money might not pay. And interestingly, this risk is not always a bad thing. It naturally arises from everyday financial and business activities. Whenever payments are expected in the future instead of today, credit risk exists. Let's start with banks. Banks face credit risk almost every day because their main business is lending money. They give loans to individuals, businesses, and corporations, expecting repayment with interest. If borrowers default, banks lose both principal and income. Banks also face risk through derivatives and trading counterparties. Even when loans are secured with collateral, problems can arise if market prices fall quickly and the collateral no longer covers the exposure. That's why managing credit risk is one of the most critical functions inside a bank. Next come asset managers. These are firms that invest money on behalf of clients, like mutual funds or bond funds. They may not lend directly, but they still face credit risk because they buy bonds and other debt instruments. If a company or government issuing those bonds defaults, the fund's value drops and investors lose money. So asset managers constantly analyze creditworthiness and monitor the quality of their portfolios to balance risk and return. Hedge funds operate a bit differently. They usually have a higher risk appetite and often invest in risky or distressed securities. Unlike traditional investors who try to avoid default, hedge funds may actually look for opportunities in troubled companies. They might buy debt at very low prices hoping for recovery, or short weak firms expecting them to fail. They also use complex strategies like credit default swaps, which increase both potential gains and risks. So their exposure to credit risk is often more aggressive and strategic. Insurance companies also carry significant credit risk, but from multiple angles. First, through underwriting, they collect premiums today and promise to pay claims later. If claims are larger than expected, they face losses. Second, they invest those premiums in bonds and securities, which introduces default risk. Third, they transfer some risks to reinsurers, but if those reinsurers fail to pay, the insurer is still responsible. So credit risk shows up in many parts of their business model. Pension funds are similar to asset managers. They invest retirement savings for employees and rely heavily on bonds and fixed-income securities. If issuers default, the value of the pension fund declines, which can affect retirement benefits. Because of this, pension funds usually follow conservative investment strategies and strict risk management rules. Now, credit risk isn't limited to financial institutions. Corporations also face it in many ways. One major source is accounts receivable. When companies sell goods or services on credit, they deliver today but get paid later. If customers don't pay, the company suffers losses. To reduce this risk, firms may use credit insurance, factoring, or guarantees. Corporations also face risk when they place cash in banks or short-term investments, because those institutions could fail. When using derivatives to hedge commodity or currency risks, they face counterparty default risk. Vendor financing, where customers buy products on installments, creates loan-like exposure. And even supply chain disruptions, such as a key supplier going bankrupt, can indirectly create credit losses. Finally, individuals also experience credit risk in everyday life. Whenever someone prepays for goods or services, there's a chance the seller might not deliver. Bank deposits also carry some risk if the bank fails, although deposit insurance in many countries helps protect savers. So even personal financial decisions involve some form of credit exposure. So overall, credit risk exposure is everywhere: banks, funds, insurers, corporations, and even individuals.